Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome. This is going to be our last show for this week. And we are going to focus on the U.S. jobs report. A strange jobs report because, of course, we are not going to get the opportunity for U.S. markets to actually respond to it. This is a bit of a unusual situation. Typically, when there's a holiday, data is pushed back or it's pushed forward. Either it comes out a day earlier or it comes out the following week for non-farm payrolls and the U.S. employment situation report overall. What typically happens is if there's a holiday on the first Friday of a given month, which is when this data is scheduled to come out, you typically get a pushback to the subsequent Friday. Not this time, though. This time, we are going to see these numbers reported without Wall Street there, without liquidity there. So even when you're looking at over-the-counter instruments like over-the-counter currencies, over-the-counter gold, which don't trade on an exchange, they are nevertheless going to be moving in an environment that's severely diminished for liquidity. Of course, internationally as well, markets closed for Good Friday, and in many markets, certainly Europe, Australia, we're going to be closed on the following Monday, on Easter Monday. So it'll be quite a while before we get a response from properly filled in markets, for markets with meaningful levels, or let's call it normal levels, or close to normal, of liquidity and participation to whatever comes out here, which of course sets us up for significant gap risk if some sort of a unexpectedly higher or lower set of numbers comes out. And this is where this gets interesting, because it would appear that we could be in for something that is in fact a bit worrying. So let's go through this and consider. Here is, first and foremost, the set of expectations that we're looking at. You can see we're, by the latest reckoning, this is from a survey of economists done by Bloomberg and is updated in close to real time, daily, seems to be when these numbers move. And you can see the expectation now, 230, so 230,000 jobs added on the non-farm payroll side of things in this report. That's the expectation. That would be the weakest number that we have seen since 2020, since COVID. This would be the softest outcome, as you can see on the chart here, since we really normalized from that COVID recession and settled into this kind of 240 to 700 and change kind of range. As you can see, of course, there's been a bit of a skew here since the beginning of last year around Fed rate hikes. So we've gone from a peak, that spike peak of 904 down to as low as 239. But 230 would be a meaningfully lower figure. The jobless rate seen holding unchanged at 3.6%. The other important number here is, of course, average hourly earnings. This is a major indicator of inflation trends, and so is a big component of what the Fed is looking at. And here we're looking to come in from 4.6 to 4.3% year on year, which would actually be, again, the weakest numbers that we've seen for the better part of 2 years. And so the implication there would be that you can see the CPI and PCE, the major measures of U.S. inflation, are tracking this with about a 3-month lag. So as average hourly earnings go, so too, it seems, inflation goes 3 months later or so. And so you see here a lead then, if the number comes in weaker, toward lower inflation. The trouble is that this doesn't seem to be good news for markets any longer. So the story, of course, roughly since the middle of 2021, when the Fed, at its June 15th policy meeting that year, basically threw in the towel on inflation being a transitory phenomenon and said, look, we're going to have a meaningful rate hike cycle here. This is not going away by itself. And indeed, the reason it isn't is wages and the labor market, that things are becoming entrenched, that essentially we had these COVID disruptions. They created an inflationary environment because of a mismatch in supply and demand for all kinds of things as various economies reopened unevenly. And that, of course, increased the cost of doing business and jacked up inflation. But, of course, that inflation then started to get baked into wages. And as it started to show up in wages, it started to show up in inflation expectations, because wages don't easily adjust back down. If you fix supply chain disruptions, you fix shipping disruptions, costs should come down. And indeed, that kind of inflation has eased quite a bit. This would be, in large part, the move that we see in inflation so far. On the one hand, we've had the Fed give us rate hikes that have cooled the demand side. On the other hand, we've had a mending of supply chains that have improved things on the supply side. And so we've come in from inflation peaks around 8-9% on CPI to 6%. But the problem, of course, is that we're not at 2 or close to 2. And the issue there, in the Fed's reckoning as of the middle of 2021 and thereafter, has been that this is starting to bleed into wages, that higher costs are pushing up the cost of doing business in a more lasting way, where people sign up for employment contracts at higher levels. And of course, if inflation comes back down, it's not as if those labor costs follow suit. They're now locked in. The only way that you can really adjust that down is with layoffs and a rehiring of folks at the lower rates. So what you see here seems to speak to that effort starting to appear. This is quite a significant downtick expected here, at least in relative terms, for average hourly earnings. To put this in historical context here, this would be the weakest average hourly earnings increase that we've seen going back to, let's call it July of 2021. So right at the start of this cycle, right where we begin to worry about these things. And looking at some of the indications that have been coming out and how the markets have treated this incoming data, and the leading numbers setting the stage for it, even just in this week, seems very telling. Let's go through some of them, and we'll have a look. So the first, of course, and this is something that we've talked about exhaustively here on Macro Money, is job openings. They surprised on the downside. Expectation was that we were going to get 10.5 million job openings and basically stay within the elevated range that we've been in. Now, job openings, of course, remain very elevated. No question about that. 9 9/10 of a million, almost 10 million here. That's a lot. By historical standards, that's very elevated considering the average was, let's call it 6 to 7 from 2018 onward, and maybe 5 to 6 before then. So still very elevated, but nevertheless, the lowest number that we've seen since May of 2021. So it seems like another indicator here suggesting economic conditions in the U.S. are at about a 2-year low, given where the labor market is in relative terms. Then there is the ISM data that came out this week, uniformly weaker than expected. The manufacturing side showing that entire sector is in contraction. Employment is in contraction. Prices are in contraction. New orders are in contraction. The overall index is in contraction, and at the lowest level, put another way, at the fastest pace of contraction since the COVID recession in May 2020. So the picture in manufacturing, pretty dire, seemingly. Service sector is doing a little bit better, still experiencing growth, but what we're seeing there, these are numbers that just came out earlier this week. What we're seeing is, again, a meaningful weakening. Numbers softer than anticipated at 51.2. So let's call it a 3-month low on growth in the sector that accounts for 75% of the U.S. economy. And tempting though it might be to chalk this up to SVB and banking crises and things like this, that's not it. Those things wouldn't have shown up in this data yet. And so what's more likely is that this is actually the U.S. economy showing signs of turning as the banking crisis was starting to hit the headlines. So it could be that we're entering something of a perfect storm scenario here. You can see that there's been a meaningful pullback in new orders. That's that red line there. The prices component continues to sink, and employment is the critical thing we're looking at here. Employment was down for the first time, or slowing, I should say, to be more accurate, slowing for the first time in 3 months. That index still showing growth at 51.3, but just barely so. Just to quickly remind, in the logic of PMI and ISM numbers, 50 is the center line. At 50, there is neither growth nor contraction. Below 50 is contraction, above 50 is growth. If we are above 50, then the further we go higher, the faster the growth. If we are below, then the further we go lower, the faster the contraction. So in the case of manufacturing here, we can see that everything started shrinking faster in the past month. In the case of services, everything started to grow slower in the past month, none of which is particularly encouraging. In fact, if we look at how the index of U.S. economic data outcomes relative to expectations has been performing, then we're looking at a situation here where there's been a meaningful reversal. Now, we haven't really returned to where we were at the beginning of this year, and we are above 0 on this index, which still suggests that U.S. economic data outcomes tend to be surprising on the upside relative to forecasts. This is, of course, the forecasts of various market economists that are typically aggregated by outfits like Reuters or Bloomberg or various others. And they measure how economic data outcomes do, and then also scale that by how reactive the markets are to surprises. And so what you see here is, of course, very eye-catching, because although it's above 0, it is a very rapid deterioration in the margin between data outcomes and data expectations, where the expectations look to have been too rosy and the outcomes disappointing. So the upshot here seems to be that the direction of travel is getting worrying for U.S. economic data. What's fascinating in this environment is that Fed rate hike odds are tellingly not rebuilding. We saw that during the SVB debacle. And certainly, I don't mean to leave this signature out. They too were of the debacle, as was Credit Suisse. We see that there's been a spike in the OFR Financial Stress Index. Not surprising, of course. That spike has since eased about halfway back to where it was. We've talked at length on this show about the idea that we still have tremendous vulnerabilities in the banking system, in particular the smaller banks, as linked to the potential for losses in industries other than tech. Of course, the SVB signature stress was really focused around the tech sector. We have opportunities for more of the same, for example, in commercial real estate. That's been a topic of conversation. But nothing is imploding today. Nothing is immediately worse today. So although we haven't gone all the way back on this stress index, we have gone about half of the way back. What's curious is that when rate hike odds collapsed right alongside that index rising, they have not then rebounded as the index has cooled. So as we get this run of disappointing economic data, the ISM numbers, the JOLTS numbers, the overall picture for data outcomes relative to expectations, which we just saw, it seems like the market is sniffing out something that isn't just the banking crisis. It seems like the market is looking at this and going, wait a second. The data is turning. Even though the banking crisis might well have been ring-fenced, at least for now, there's no reason to rebuild these Fed rate hike odds because economic conditions have caught up in a way where you wouldn't expect Fed rate hikes because the economy itself is floundering. You can see that in the behavior of the yield curve. It's been smashed lower in the wake of SVB. That much you can see here very clearly. So before SVB, you were looking at rates peaking north of 5.5% and staying there for at least a year, and then sliding under 4 over the course of 2 years to land ultimately somewhere around 3. What you're seeing now is, of course, we're going to barely eke out some time under 5. So you can see the peak here expected to be a month from now, basically toward that 5 peak. Looks like for the next 3 months, we're going to hover in that 4.75 to 5 range that we're in now. Fed policy, of course, set in ranges at this point. So we're currently at 4.88, which puts us in a policy rate range from 4.75 to 5. You can see that we're staying in that range for the next 3 months. So the 1 month number 4.99, 3 month number 4.93, 6 month number under 4.75. Now in the 4.5 to 4.75 range at 4.6. That's a first hike, or a first cut rather. We're so conditioned to hikes that it just comes right off the tongue. But no, that's the first cut. And from there, the situation accelerates. What's particularly interesting is that over the past week, the curve has gotten flatter, even as financial risk has ostensibly eased off. So one can only turn around and say, well, why? What's going on? And the economic data becoming soggy really jumps out. So it would appear that the market is looking at the current situation and saying, recession risk is rising. The economic data has turned negative. Fed rate hike odds have no reason to rebuild. We're in a situation where it's not so much the banking crisis we're afraid of, it's a more generalized deterioration in the business cycle writ large. You can see it in these Fed rate hike odds. So right now, it looks like we're about 50-50 on another hike for May. You can see the likelihood, basically a toss-up. So if you look in the percent hike cut column, that's at 50.4. And in the implied rate delta column, you can see we've baked in 13 out of 25 basis points of another hike. In other words, about halfway. Things start to rapidly deteriorate from there. So you can see a hold in June with about a 13%, 14% chance of a cut, which is, of course, minuscule. And so it would appear that there we're just going to spin the wheels. But as you get into July, things start to escalate in a more dovish direction. 65% chance of a cut at that point. And come September, the cut is in. You can see in the implied rate delta column, the rates are expected to be 29 basis points lower at that stage than they are now. So that's at least one 25 basis point cut. Come November, we're down 47 basis points as relative to now. So you can see 89% chance of a second cut. Look at that number of hikes cuts column for November, and you can see minus 1.89. So that's down at least one hike, or essentially a cut, or 89% chance for two. So down 1.89. Come December, it's a negative 2, so both of those cuts are in. And there's a 59-60% chance that we're already there at a third. In the implied rate delta column, you can see 65 out of 75 basis points in cuts that would be implied by 3 decreases at 25 each are already in the market. Come January, all 3 are in. And there's about a 50-50 shot that by then you're already at a fourth. 85 basis points in cuts already priced in out of 100. So there's clearly a very dovish view here of where Fed policy is going, even though bank crisis risk isn't getting worse. Ostensibly, it's getting a little bit better, at least in terms of current stress conditions. Certainly not the underlying situation. That is basically in stasis. So the market may well be sniffing out recession. And if these numbers that we are looking at for NFP shock on the downside, much as we've seen the ISM numbers underperform, much as we've seen job openings underperform, that might well get validation. And to the extent that it does, it might well end up negative for stocks, negative for cyclical assets that depend on a robust business cycle for their gains. So think crude oil, which had a spike earlier this week that essentially went nowhere. We talked about that on some of the other shows that we've opined on it, most critically on First Call with Tom and Tony this past Sunday, and of course Overtime with Chris Vecchio, head of Futures and Forex here, the show that precedes Macro Money Monday through Thursday every week. Copper, natural gas, as you go down the list, a lot of these growth-based sort of assets looking vulnerable in that kind of environment. Interestingly, the yen looking supportive in a risk aversion environment, when that risk aversion is built around a downturn in the business cycle rather than an increase in yields. When yields rising are the reason markets get spooked, much as the case was for all of last year for the most part, the yen doesn't tend to do well because it yields nothing for the most part. So when yields increase, the yield advantage for assets not denominated in yen expands. And the incentive to own yen evaporates. In fact, you start to have an incentive to borrow for nothing in yen to buy higher yielding things, what's called the carry trade. And so you have a situation where the yen doesn't strengthen in that environment. On the contrary, it tends to weaken significantly. That has changed with this latest set of developments in the past week or two. The yen suddenly is moving inversely of stocks again. And that's something that would indicate stocks are not going down because rates are going up or are expected to. Something else is afoot, which would be consistent with what we're seeing here, where the outlook on policy is dovish, increasingly so, but credit crisis risk is improving. So something else is seemingly going on, and that the yen starts to become inversely correlated with stocks again seems to confirm, or at least go some way toward confirming, it's a growth risk that the markets are perceiving. Of course, the other hugely important aspect of this is the US dollar. You can see this is where the dollar is a bit of a special case. The dollar smile framework here that was put together by Stephen Jen tells a story where the dollar does well when the U.S. economy is particularly strong. That would be the story of last year, where you get a strong economy that feeds inflation, that feeds interest rate hikes, that makes the currency more attractive because, of course, one person's higher borrowing costs, which is what interest rate hikes do, is another person's increased lending income. So owning a currency with rising interest rates confers a greater return, a greater, if you will, dividend yield. Not so much price movement, that can have its own influences. But of course, when you confer a greater dividend yield, essentially, on a currency, more people want to own it. And so the price tends to follow. That's the right side of this, where the U.S. is growing strongly and the dollar follows suit. But then there's the flip side, where the U.S. is doing poorly and the dollar gains. And that's risk aversion. That's capital cashing out of riskier assets in an adverse economic environment and choosing the dollar as the cash of choice, which of course makes sense. It is by far the most liquid and therefore by far the most able to actually absorb all of that without dramatic movement. The latest numbers from the Bank of International Settlements suggest that as of last year, the dollar accounted for 88% of global monetary transactions, which, among other things, make this idea that some sort of a BRICS-based U.S. dollar alternative is coming, or that there's de-dollarization coming, sound like utter nonsense. And of course, we did an entire show on this yesterday. Do come and check that out if you're interested in a more deep dive. But this clearly catches it, that in times of stress, the ubiquity and the liquidity of the U.S. dollar see cashing out into it. And so it might stand to benefit interestingly, even if, and perhaps especially if, the U.S. jobs data ends up looking sour and Fed rate hike odds are at least confirmed in their dovish setting, or perhaps even pushed further in that direction. Tellingly, if you look at the monthly chart of UUP, the US dollar ETF that broadly tracks the DXY US dollar index, you can see it put in a very impressive bullish engulfing candlestick pattern, suggesting a reversal higher above support at 27.19. That's the former range top that was keeping the dollar capped going all the way back to the global financial crisis in 08-09. And perhaps signaling that the longer-term rising trend in the dollar, conservatively from 2014, the last time we started to unwind policy easing, and more ambitiously from the ultimate low back in 2011, that multi-year trend, that 10 to 12 year trend, is about to get the next leg higher. So this is something that, of course, could look like an interesting opportunity if confirmed, and could confer the chance to enter into what might be a very significant, long-lasting move as recession risk really builds. So this jobs report should be very interesting, and the fact that markets are going to be closed during it might well amplify its impact. One trick to see how the markets might respond is to look at spot. Because, of course, those markets aren't going to close for any holiday. They don't operate on an exchange, so there's nothing to close. So looking at spot dollar rates, spot gold rates, and how they behave should be very interesting. We're going to be looking at those things with Tom and Tony on First Call Sunday. So if you want to take a break and you're celebrating your Easter holiday, do come join us for that. We're going to be trying to figure out what the indications are after that jobs report. With that, we conclude Macro Money for this week. We will, of course, be back next week as per the usual, Monday through Thursday, just after overtime with Chris, and back for Futures Power Hour with Chris next Friday as well. If you want to catch me outside of those shows and First Call, you can follow on Twitter at Ilya Spivak. Have a very happy holiday out there, everybody, whether you're celebrating Passover or Easter or whatever else, or just enjoying the time off. We'll speak to you guys soon. Take care.